Hi, this is Chris Conklin with Miller Newberg Consulting Actuaries, and welcome to today's webinar on asset adequacy analysis. Now, you may not have thought about what asset adequacy analysis is, other than it's something that your actuary performs on an annual basis and puts together a long report that nobody reads. But here's the reality of what it is. It is designed by regulators to be the early warning system against insurance company failure. And so if you think about what the Federal Reserve does for banks, for example, it puts large banks through what they call a stress test. Takes a look at a number of different economic scenarios and tries to determine, will that bank survive or fail that scenario and that set of scenarios. Well, for insurance companies, there is a similar analysis that's put together, but instead of being done by the regulator, it is done by insurance company actuaries, and it is asset adequacy analysis. So thank you for joining me today, and we're going to talk about what this analysis is and what you as an insurance company executive or insurance company director should learn from it and use. So let's start about the idea, do insurance companies fail? And the answer, unfortunately, is yes. Insurance companies fail. In fact, if you've been in this industry for a while, you've certainly seen it happen. I can tell you that personally, I had a relative who had an annuity with an insurance company that failed. There was another company during the 2008-2009 financial crisis. I knew a couple of folks who were on that company's sales team, and the company failed quite unexpectedly to them. And even more recently, only about 3 years ago, there was an insurance company where some of my former colleagues were senior managers of the company. One was the CEO, and the company failed. And really, from as far as I could tell, they couldn't see it coming. It was a surprise to them. And so, insurance companies fail. They can oftentimes fail suddenly and quite unexpectedly. And as a result, regulators have said, there needs to be an early warning system. So let's take a look at what can cause some insurance companies to fail. It is often a problem on the asset side. So an example that highlights that is Executive Life, a fairly large company in 1991. It had a large portion of its asset portfolio in high yield bonds. Why? Well, it felt that they could adequately understand the risks they were taking, that they could properly choose which underlying companies, of these issuers were relatively safe relative to the yield. And so they felt they had an expertise there. Well, 1991, a recession hits. A lot of those underlying companies had more financial difficulty than Executive Life expected. The market value of those bonds fell quite a bit. And as a result, the company became insolvent. And so it can be a problem on the asset side. Also, it can be a problem with the mismatch in the assets versus the liabilities. So let's talk about a company that was in St. Louis, 1999, General American. General American had sold a lot of, they're called funding agreements. Funding agreements, no different really than annuities, other than annuities are purchased by mom and pop folks with their retirement savings. Funding agreements are generally purchased by more sophisticated entities, such as financial institutions or so forth. But fundamentally, the product is an annuity. Has principal guarantee, has a guarantee of interest crediting, has a surrender charge. It's an annuity. So General American had sold a lot of these short duration annuities and had them backed by long-term bonds. And the reason I say they were short duration funding agreements is because General American had a provision in there that said, yes, there's a long surrender charge, but you can get out your money at full book value with just 7 days notice. So if at any point you want to take a withdrawal, even if your entire balance, you have the right to request that 7 days advance notice. We waive the surrender charge. That ended up being a problem for General American because as interest rates rose, a lot of their customers realized we can get a better deal elsewhere, and we can get out of General American without a surrender charge. So let's call up General American and get our money out so we can move it somewhere else. And too many of General American's customers did that in a short period of time, and they ended up failing. So these scenarios can happen. These scenarios do happen. And as a result, regulators want there to be an early warning system so that company management can know and so that regulators can know that this risk exists within a company, and so that there can be a conversation around that risk, and so that maybe the company can change course and do something to mitigate that risk, so that indeed, if the economic scenario, the problematic economic scenario plays out, that the company actually has changed something about their assets or their liabilities so that they can survive the scenario. And so this truly is designed to be an early warning system against insurance company failure, so that company management or regulators can do something about a situation that hasn't played out yet, but that could play out. So what is this asset adequacy analysis? What is this early warning system? Well, it's an annual regulatory requirement, which is why your actuary does this analysis every year. Its genesis came back in 1986 with New York. New York put in place Regulation 126, which required all companies that were licensed in New York to put together this annual asset adequacy analysis. Regulators in the rest of the states ended up thinking this is a good idea. And so in 1990, it went national with some changes to the NAIC standard valuation law and with the introduction of the NAIC actuarial opinion and memorandum regulation. So since 1990, every insurance company all across the country, both large and small, has been having their actuary put together an asset adequacy analysis. So what is this asset adequacy analysis? Well, what it is, it's an evaluation by an actuary of an insurance company's assets and liabilities. And so if you take a look, let's just start on the liability side. So an insurance company has in force a wide variety of coverages. For example, they've sold life insurance. If you look at life insurance, with life insurance, there's going to be future death benefits. There's going to be future surrender benefits. There's going to be premiums coming in over time. And all of that boils down to a single number, effectively, that's the reserve. Same thing with annuities. The company is guaranteed to credit certain interest rates. Maybe there's expected ongoing deposits to be coming in. There's expected future surrenders and annuitizations and things like that. All that's boiled down to a single number, which is a reserve. All right. Now, on the asset side, the company has purchased a bundle of assets that are all being held at their book value. And so in the asset adequacy analysis, what the actuary does is the actuary takes an amount of assets with book value equal to the reserve and creates a model of those things, models each of those liability policies individually, and models each of those assets individually, and then takes a look at a variety of future interest rate scenarios and makes some assumptions as to what will happen to those liabilities. If interest rates go up, how likely are those customers to leave if interest rates go up? If interest rates go down, how likely are those policyholders much more likely to stay in that sort of scenario? And so, we take a look at what do we think is going to happen with each of these liabilities. And then similarly on the assets, if interest rates change, how are the cash flows coming out of the assets going to change? How are the market values of the assets going to change? And so we put together this grand model and we run a whole bunch of future interest rate scenarios. And we take a look at the question of, this bundle of assets, are they sufficient to satisfy the liabilities? And of course, everybody hopes that they are sufficient. But if it turns out that, in some of these scenarios, they're not sufficient, then the actuary has to consider asking the company to set up something called an asset adequacy reserve. Now, what an asset adequacy reserve? It's simply the mechanism where the actuary pulls additional assets into the analysis. Assets that are backing the company's surplus are brought into the analysis to help the company pass more of these scenarios. And if that ends up being necessary, then the actuary tells the company you need to put on your balance sheet an asset adequacy reserve, and they tell the company the amount of the dollar amount to set up. Now, setting up an asset adequacy reserve means that the company ends up having some of its surplus reclassified as reserves, as a liability. And nobody wants that. And so success is when the actuary gets to tell the company, you don't need to have an asset adequacy reserve. Everybody recognizes that success. But really the value of this whole exercise comes down into all of these scenarios allow a company to peer into the future and take a look at which of these scenarios are problematic. And is there something I can do today that would make those scenarios less problematic? So what are these future interest rate scenarios? Well, in New York's Regulation 126, they prescribed 7 scenarios that they wanted to see the actuary put together. And those 7 scenarios are still required in New York today. And because New York was first, actuaries run these scenarios even for companies that aren't licensed in New York and present them as part of their asset adequacy analysis because New York set the standard. So the first scenario, and the one that really is often easiest for the company to survive, is when interest rates simply remain at today's level. That typically is the rosiest scenario of all the scenarios we're going to see. Then the next 3 scenarios are all scenarios where interest rates increase from today's level. And then the final 3 are scenarios where interest rates decrease from today's level. Now, some of these scenarios are rather harsh. So for example, take a look at the 4th one. Interest rates immediately increase 3% and then stay there forever. Well, we really haven't seen interest rates ever increase 3% in a day. So it's a harsh scenario. What you'd see the company's reality change in a heartbeat. The market value of their assets would change dramatically. How their policyholders are thinking and what their policyholders are doing would change dramatically. Same thing if interest rates immediately decrease by 3% and stay there forever. All of a sudden, the minimum guarantees in your company's block of annuities, for example, the minimum guarantees built into the cash value scale of your life insurance products might become really problematic very quickly in that scenario. So because these 7 scenarios collectively are rather harsh, oftentimes a company will fail 1, 2, or even 3 of these scenarios, and the actuary may feel that the company really is more stable than these New York scenarios, the picture these New York scenarios paint. And so as a result, actuaries will often add additional scenarios to the analysis to try to create, in the actuary's mind, a more realistic picture of the company's situation. So what actuaries will often do is they'll perhaps create some just additional scenarios they made up, or they may use a variety of random, what's called stochastically generated interest rate scenarios where, these 100 scenarios, for example, where interest rates, some of them go up, some of them go down, some, just gyrate all over the place. And the point is that it helps to give maybe a little more scientific picture around the company's survivability. Maybe the company failed 2 of the 7 New York scenarios, but maybe it passed all of the 100 randomly stochastically generated scenarios, or maybe passed 99% of them. The actuary can tell that story, and it can be part of the picture that management understands and the regulators understand as to this company's survivability in an adverse scenario. So now let's talk about what happens in these various scenarios, because there will be some scenarios where interest rates increase. That creates one set of problems. There'll be some where interest rates decrease. That creates a separate set of problems. So let's talk about each of those problems. So first of all, in scenarios where interest rates increase, especially if interest rates increase a lot, problems can happen in a hurry. And the reason why is that for your customers, all of a sudden, they have a bunch of higher yielding alternatives available to them. Maybe you have an annuity that you're crediting a certain interest rate, and maybe that was a really attractive interest rate before, but now with interest rates being so much higher, your customers are looking around and seeing, if I move this money somewhere else, I can get a much higher interest rate, somewhere else, maybe in another annuity, or maybe, in a savings account even, or a money market account, or a CD, or whatever. And so they recognize, maybe I should move the money. And so they're increasingly inclined to surrender their existing contract with you and move their money to a competitor's product. But at the same time that's the customer's situation, your situation is difficult, because what will happen if interest rates increase is that the market value of your assets will drop. And that's because the yield on most of your existing assets is locked in for a long period of time. So the end result is your assets have lost market value. You don't have the income to increase the credited rates you're offering to customers, your customers are demanding more money from you at the exact time that you have less money available to you to provide benefits to them. And so problems can happen in a hurry in scenarios where interest rates increase. And that's exactly, of course, what happened with General America. Now, in scenarios where interest rates decrease, a different set of problems can develop. And these problems typically take longer to develop. They happen more over the long run. But they are significant nonetheless, and they can lead to company failure nonetheless. All right, so in a scenario where interest rates decrease, oftentimes you will work down your credited rates over time, but all of your products have a guaranteed minimum credited interest rate. And so let's suppose that you've taken all of your customers down, their credit rates down to the minimum guaranteed interest rate, and you have no ability to take it any lower. And yet, interest rates, as they get lower and lower and lower, as your existing assets mature, you have to buy new assets, new investments, and they have low yields. Possibly those yields are even lower than the minimum rate you have to credit to your customers. And so the end result is, in a low interest rate scenario, you can end up in a situation where you've promised your customers, guaranteed your customers more money than you have the ability to earn. And that can lead to your company's insolvency over the long run. So this is an adverse scenario. So hopefully you can see what I'm talking about now, where the scenario where interest rates just stay where they are today is often the rosiest scenario. If interest rates go up, it creates one set of problems. If interest rates go down, it creates another set of problems. And asset adequacy analysis looks at all of these scenarios and takes a look at how bad would these problems be for you. All right, now success, as we mentioned, is when your actuary says, you know what, you don't need to set up an asset adequacy reserve. In other words, when your company generates positive surplus over time in the overwhelming majority of these scenarios. It is not unusual to fail some of these scenarios, and that doesn't necessarily mean that you automatically must set up an asset adequacy reserve. It really is your actuary's judgment call as to whether you need to set up an asset adequacy reserve and how big that reserve needs to be. Now, this, by the way, your actuary knows that this is also subject to the regulator's judgment. Just because the actuary thinks maybe one isn't required, they have to recognize that the regulator may say, one is required. In our judgment. And so the actuary needs to be a little conservative here and recognize that, regulators are going to look at this. They're going to have their own opinion. I want to make sure that my opinion will stand up in their eyes. And so, like I say, one failing scenario doesn't mean you need to set up a reserve, but it does mean your actuary needs to think about it and has to make a decision. Do you need one or not? So let's suppose your actuary has not told you that you're failing any scenarios. Well, that doesn't mean you didn't fail some scenarios. So take a look at your what's in red here. This is your homework. All right, go back to the most recent annual report written by your actuary, the most recent annual asset adequacy analysis, and take a look. How many scenarios did you fail? And not just how many scenarios did you fail looking at the end of the projection, because oftentimes the actuary will put together a summary that says, at the end of the 30th year, here's how many scenarios the company failed. Well, quite often, if the actuary had instead said, let's take a look at this at the end of 1 year, or at the end of 5 years, or at the end of 10 years, the number of failing scenarios would have been a different number. And, and realistically, you can get into trouble at any point, right? It's not just, were you in trouble after 30 years? Well, were you in trouble after 1 year? Were you in trouble after 5? And you can find that answer in the report that your actuary has put together. Maybe your actuary hasn't put together a table that says that, but somewhere in there you can find it. And if not, ask your actuary to give you an additional table that says, all right, if we had stopped this after 1 year, how many scenarios would my company have failed? If we'd stopped after 5, after 10, after 30, how many would my company have failed? And any failing scenario is one that can teach you something, that can teach you that there's a problem here that you might want to take some steps today to address to prevent your company from failing if that scenario actually ends up playing out. So let's talk about what helps or hurts your results in your asset adequacy analysis. And it starts on the liability side, then we'll move to the asset side next. But on the liability side, this is a list of things that help your company pass. First is, let's suppose that your company is already voluntarily holding reserves above the minimums, such as you're holding reserves equal to the full account value when the carve-in reserve is some lower number. Well, this is an example where you've already taken some money that could have been called surplus and you've put it in reserves. And so, of course, naturally, that's going to help you pass your asset adequacy analysis. Next, how loyal are your agents and customers? If interest rates go up, and how likely are they to stay with you despite the fact that they no longer have what in that scenario is a competitive credit rate, versus how likely are they to leave? General American suffered from really too few loyal agents and customers. How's your profitability relative to your size? I mean, this is a relative thing, but is your profitability high relative to your size? That helps. If it's low relative to your size, that hurts. What's the makeup of your in-force business? If you have lots of life insurance, lots of SPIAs, that helps. Why does that help? Well, first of all, SPIAs, no matter what happens with interest rates, your customers don't have the ability to change the payout coming from their SPIA. They can't change the amount. They can't change the timing. Everything's locked in. And so no matter what happens with interest rates, SPIAs will have completely stable cash flows. Similarly with life insurance, interest rates go up. It doesn't really make your customers necessarily more inclined to say, let me replace my existing life insurance contract with something else, which requires going out and getting new underwriting, a whole hassle around that. And, the chances are they aren't thinking about rate of return very much when it comes to life insurance anyway. So lots of life insurance, lots of SPIAs help you pass asset analysis, and lots of deferred annuities tend to hurt more, because those are folks who are much more focused on what's my interest rate, what alternatives are available to me, should I make a change? It helps to have a lot of deferred annuities on the books where you have the ability to change the credited rates, so that if in a rising scenario, do you have the ability, if you want, to increase the credit rates to keep the people around? In a falling interest rate scenario, do you have the ability to take the credited rates down to make sure that your profitability stays where it needs to be? Do you have that ability? More ability to change credit rates helps. What are the lifetime interest rate guarantees on your annuities? It helps to have low lifetime interest rate guarantees, so in a low interest rate environment, you still have the ability to earn sufficient investment income to fund your liabilities, even if they're at their lifetime minimum interest rate guarantee. Lots of companies have blocks of annuities with 4%, 3% lifetime guarantees. May not have seemed all that problematic when those annuities were first being written. But we've definitely seen, over the last decade or so, that lots of companies had trouble, earning a sufficient rate of return to fund those annuities at those guaranteed interest rates. And then finally, it helps to have products with long, high surrender charges and market value adjustments, features which lock customers in, that make it harder for them to leave, no matter what's happening with the interest rate environment. So that list of items there, all of those things are what helps. And of course, the opposite of each of the above items is what hurts. So for example, if you're holding your reserves at the absolute minimum level, if your agents, customers, are very inclined to always be looking at, how do I get maximum value? And if this company isn't providing it for me, let me go take it elsewhere. If your profitability is already suffering a bit, all of these things hurt you. Now let's take a look at the asset side. As we saw with the executive life story, it was an asset problem that caused them to fail. With General American, it was a mismatch between their assets and their liabilities that caused them to fail. The asset side, incredibly important. So what helps? What helps is to have a tight duration and dynamic cash flow match with your liabilities. So what I mean by that is, for example, let's suppose that you have a big block of annuities whose surrender charge is ending in 3 years. And so in 3 years, there's a large block of customers who are going to have the ability to take out their money on a moment's notice without any surrender charge. Well, you want to make sure that you have a bunch of assets, a bunch of bonds that are maturing at that same time, so that you have the cash available to satisfy whatever your customers want to do. If they want to take their money, you've got the cash sitting there. If they want to stay with you, you have the cash that you can then reinvest for how long at that point it looks like they're going to stay with you. It really helps on existing assets to have a high yield relative to the duration. And then related to that, it helps to have a high reinvestment assumption. So what do I mean by reinvestment assumption? Well, reinvestment assumption means that, in the asset adequacy analysis, typically your actuary is going to be running out a scenario that goes 30, 40, 50 years into the future. And 30, 40, 50 years into the future, the assets that are on your books then are going to be assets that you've purchased after today. They're not your existing assets. They've all matured, or at least most of them have. It's future asset purchases. And so your actuary is making an assumption as to what sort of assets you're going to purchase in the future, what's going to be the duration of those assets, what's going to be the yield and the characteristics of those assets. If your actuary can get comfortable around assuming a high yield relative to the duration on future asset purchases, that helps your company pass the asset adequacy analysis. Now, how does your actuary get comfortable with making a high reinvestment assumption? Well, by having your asset manager have a track record of creating high yield relative to duration, of supplying those kind of assets to you, of you having those kind of assets already on your balance sheet and a ready supply of them coming to you from your asset manager. And so each of these things is what helps. And of course, the opposite is what hurts. We certainly saw with General American, that first bullet point, they did not have a tight match between the duration of their assets versus the duration of their liabilities. Their liabilities had the ability to leave on 7 days notice. Their assets were much longer term than that. All right, well, let's give you an example of a recent success story here at Miller & Newberg. We had a new client that came to us a couple of years ago, and here was the situation that they were in when they came to us. Their annuities, their liabilities were mostly annuities, and we mentioned, that's something that hurts. They didn't have a whole lot of SPIAs, didn't have a whole lot of life insurance. It was mostly annuities. On those annuities, the credited rates were largely guaranteed and unchangeable. So that hurts. And the surrender charge periods were short. 1 year, 2 years left on the surrender charge period. That hurts as well. Okay. But to fund the credited rates that they had guaranteed on these annuities, they needed a decent amount of yield. And so to get that yield, they were mostly invested in long-term bonds, so 20 plus years to maturity. And so their prior actuary recognized that this was a problem. Okay. That having a bunch of assets that are 20 plus years to maturity, not having a whole slew of them maturing in 1 or 2 years when the surrender charges are ending on these annuities, when people could leave, you could have, this company could end up having a real problem here. And so their actuary came to them and said, you need to set up an asset adequacy reserve. When they did that, that reclassified a bunch of their surplus as a liability. And so the end result is that they didn't have a whole lot of surplus. Their risk-based capital was now in the danger zone, and that got the attention of their state regulator. And so this is the situation that the company came to us with. And of course, the first thing we looked at is, all right, well, if we shorten up your bond portfolio, what's going to happen? And the reality is that the yield then would have been insufficient to cover the interest that they had guaranteed to credit. So there was no solution there. So tough situation, right? It turns out they needed both a liability solution and an asset solution. And so we worked with their asset manager and their senior management team and delivered the complete solution. On the liability side, we took a look at all of the products that they were offering, and we had them stop offering some of their products. And some of these products were products that other companies could profitably and safely offer. But in their situation, they needed to have products that broke even quickly, products that didn't create a lot of surplus strain at issue, products with longer surrender charges when it came to the annuities. And so we've revamped their product portfolio, had them stop offering much of what they were selling, and introduced new products that if they sold these new products, it would help them. We also worked with their asset manager, who then introduced them to some new asset classes that got them higher yields relative to the duration. These are asset classes that the asset manager had not gotten this company into previously, but they were able to supply a ready supply of assets, different asset classes, higher yields relative to duration. And when you put the liability side solution and the asset side solution together, we were able to instantly eliminate the asset adequacy reserve, get their risk-based capital ratio back out of the danger zone, and put them in a place where every sale they were making from there on out was going to help them, was going to make them stronger. And so this company, just a couple of years after being in this danger zone situation, is in a much better situation today. And so that's a great example of the type of success story that can come out of asset adequacy analysis. This company is much more stable, financially strong, much more able to survive an adverse economic scenario than it was a couple of years ago. So what do you need to do if you have been told by your actuary that you need to have an asset adequacy reserve? Well, first of all, if your actuary has said you need to have an asset adequacy reserve, it is a serious matter, because actuaries know that telling a client they need to have an asset adequacy reserve, that's bad news. And so if the actuary feels compelled based on everything they've seen in their analysis that, yeah, you have a problem here, and they tell you need to have an asset adequacy reserve, the reality is, yes, you have a problem. You may actually have a problem if your actuary hasn't said that, which is why you want to take a look at the results that your actuary has presented, dig deeper into how many scenarios did we fail? Did we fail more of those scenarios if we looked only 1, 2, 3 years into the future versus 30 years into the future? What is our problem, right? What is the scenario that hurts us, and why does it hurt us? And so, getting into a situation where you have an asset adequacy reserve probably took your company years. And so as a result, sometimes it will take years to work your way out of it. Sometimes it's just not that easy to solve the problem quickly, like in the example I just said. And so it's best not to get to this point in the first place. But if you are at this point, it really comes down to a good actuary and a good asset manager can work together. They can work together to help put together a strategy that'll get you out of this, to make decisions that move you along the path to profitable, responsible, less risky growth. And so that's your team. Get your actuary together, get your asset manager together, take a look at the results of the asset adequacy analysis, have them explain to you, what are the problematic scenarios and why are those scenarios problematic, and what can you do today to make it so that if that scenario happens, it's less problematic than we presented in this analysis. And that helps to get you along a path to having a stronger, more robust, more sustainable company. So our key takeaway today is, don't just rest on the knowledge that your actuary didn't say you need to have an asset adequacy reserve. Take a look at your actuary's asset adequacy analysis. Take a look, are you failing in some scenarios? If you looked at different endpoints, would you have been failing in some scenarios that your actuary actually said you passed because you passed after 30 years, but maybe you didn't after 1 year or 5 years? Have your actuary lead you through an explanation of what is that scenario telling you, and explore taking some steps today on both the asset side and the liability side to improve your risk profile. We definitely don't want you to be one of those companies that all of a sudden failed, and the senior managers didn't expect it, and the directors didn't expect it, but it happened. And your asset adequacy analysis is designed to be their early warning system to give you insights, so that are you in potential trouble or not. And so take a look at your actuary's asset adequacy analysis. And if you have any questions about asset adequacy analysis, if you'd like us to take a look at your existing analysis, we'd be happy to do it. So you see my contact information on the screen. At Miller & Newberg, we are the appointed actuary for many insurance companies. We are performing asset adequacy analysis for quite a few companies. We are very good at this, and we would love to help you understand what your company's asset adequacy analysis is telling you.